You're listening to Kitchen Table Finance. Join Dave Shotwell and Nick Nauta as they cut through the complexity of financial planning and serve bites of investment advice that are both personal and practical.
I am fantastic. Beautiful day for a podcast. So feeling good about that. Heading out on a little vacation next week. So all things good. Going to enjoy the last month of summer here.
And that also means we're coming into review season. So it's a double whammy. Yeah,
that is right. So I'm excited about today's topic, Dave. We're going to talk a little bit about insurance and what exactly you should be insuring and maybe some tips for some things to potentially avoid.
This topic really grabbed me just yesterday when you were asking what we should podcast about, because I got this glossy flyer in the mail from one of Michigan's major utility companies, and my legal counsel has advised me not to name them because I'm sure they're listening in on our podcast, and she doesn't want me to necessarily defame them. But anyway, so what this flyer was all about was how expensive it is to repair your appliances and how they can make that so much easier by providing an insurance/warranty service. And it was glossy and pretty, and it was right on the front cover was, where will your next appliance breakdown happen? Your AC, your water heater, your refrigerator? Check the box. Yes, I want to save money, or no, I would rather pay hundreds of dollars for heating, cooling, and appliance repairs, because those are the only choices, right? Either you buy, either you want to save money by buying their insurance program, or you want to spend hundreds of dollars repairing your heating, cooling, and appliances. So, a normal person would have probably chucked this thing right in the garbage, I would hope, but I'm not a normal person. So I opened it up and pulled up the website with all the fine print, because it told me where to go for the details. Because the normal person's brain is going to look. So on the flyer, it said, they had a couple different levels of coverage. The core coverage, what they called the core coverage, was $20 a month. Okay. Not super exorbitant, probably less than a lot of people are spending on coffee right now.
Yep.
With a $75 deductible. And it said it covers your air conditioner, your furnace, your water heater, but it didn't specify anything about what repairs are actually covered. So it was $20 a month, so $240 a year, plus $75 if you need to actually have a repair.
So for our listeners, Dave, do you want to talk about what a deductible is?
The amount you pay per occurrence out of your pocket before the insurance picks anything up. Okay. So right off the bat, you're essentially committing to spending $240 a year on appliance repair, whether you need it or not. Okay. Right.
Yep.
Right.
Some cost,
and
right?
So then I pulled up the details. And so when the human brain reads these kind of things and says, okay, if I just spend $20 a month, I never have to worry about my air conditioner again. Right. That's the thinking. Right.
Right. Yep.
But then what you've got to do with these things is look at the details. Right. Because yes, if you could spend $20 a month and never worry about your heater, your air conditioner, that might be not a bad deal. Okay. But so what does it cover? Yeah. It covers repairs, unless those repairs are worth more than the appliance is worth. That was the first caveat. So if you've got a refrigerator that's a few years old, how much is it really worth? It does not cover replacement if your appliance actually is just DOA. If it can't be fixed, they're not paying you to buy a new refrigerator. Okay. Or a new furnace.
So I'm curious here, Dave, and I'm pretty sure you know the answer, but who gets to decide what the appliance is worth?
They get to decide that, not you. they specify that it must be in good order when you start the contract, but they didn't really say what that meant. But if it's already broken when you sign up, they're not
right.
That one, I'll give them that one, right? But then okay, so
sense.
start looking at the list of exclusions: fire, flood, pest damage, attempts you may have made to fix the appliance, power outages, power surges, acts of God, or abnormal conditions are all excluded. And there were more, but those were the exciting ones. And so I'm thinking, okay, what's going to happen to my air conditioner other than these things? Now, I don't own an air conditioner, but if I did, what's going to happen to it? Like the things that I think about are like a tree falling on it. I guess that would be an act of God. Squirrels in northern Michigan, squirrels like to eat everything. So that's always a concern. Yep. That's not covered. The next one kind of got me though too. So if the repair cost exceeds $1,000, it's not it doesn't get covered either. So you're essentially saying I'm going to spend $240 a year plus a $75 deductible, but if it's like now we've got this narrow window where it might be a good thing. Like if your repair is like $310 to $1,000, great, you're covered, But assuming it was because I guess that leaves like mechanical failure of the parts that's covered, but not, not anything outside normal wear and tear, then I guess would be so if your air conditioner fan dies because it just runs all the time, that's a scenario where you'd be covered. But if the maple tree splits in the backyard and falls on it, you're not covered. So anyway, the whole point of this is you've really got to look at what you're actually getting covered, and a lot of people don't do that in these instances. But it kind of I'm getting all worked up about a specific example just because I got it in the mail yesterday, but it kind of leads to a bigger philosophical discussion about warranties, insurance. What should you insure versus what should you just not cover and save for and plan to pay out of pocket if it happens? And, so say instead of buying the insurance, you put $20 to $30 a month into a savings account labeled appliance repairs. I've got to think for most people, you'd be better off than buying this insurance. It's possible that your air conditioner and your furnace would die at the same time while you're just starting to save. I shouldn't say die because that wouldn't be covered. That they would have a mechanical failure that would be covered that you hadn't saved for yet. But what are the odds of that?
Right. Well, I mean, if you're doing quick math, $240, the $20 a month, you'll have $1,000 in 4 years. So depending on the age of your appliances, chances are you're not going to be better off with the insurance. Like you're paying basically a quarter of the potential insurance every year for if something were to happen, right? Like your maximum that you can get out of it is $700 or $699. It's got to be under $1,000. So I always look at it in terms of like how much of the percentage of what I'm going to get versus how much I have to pay, and what does that percentage look like? It
all comes back to our old saw that we use all the time about having a contingency fund and being able to cover these kind of expenses when they arise rather than have to insure them.
Absolutely. I mean, if you think of it in terms of, hey, if you've got, 3 to 6 months of expenses in there, that money sitting in a savings account, which is actually probably hopefully earning some pretty decent interest. I mean, a lot of those accounts are up at 4%. So now you're getting paid to self-insure a little bit, which is always a good thing, versus paying an insurance company for the potential that something bad might happen, but only getting limited coverage for that cost.
So Nick, what should you use insurance for? What's a scenario where it makes sense to insure something?
So I look at it from a philosophical level of what could potentially happen that would be catastrophic enough that I wouldn't be able to cover it, right? So there's a long list of things that could potentially come into play. But the whole point of insurance when it was originally formed was, hey, if somebody's house burns down, they probably don't have the money or the capability to replace it. But we also know as the insurance company that there's a small percentage of houses that are actually going to burn down. So if we get enough people to buy into the insurance at a low cost, then we can cover everybody's house, and nobody has to be that one.
Everybody pays a little bit
that doesn't have the money
to cover something that would be catastrophic to them. So you need two things to be true for insurance generally to make sense. The event would have to be catastrophic. House burns down. You still own the bank for your mortgage. You need a lump sum. You need a place to live, right? Mm-hmm. So that's a catastrophe that you need to deal with. Or your brand new car, you get in an accident, you need to pay the bank back, and you need wheels. Mm-hmm. That's a catastrophe from a financial standpoint, or, catastrophe may be strong, but you know what I mean? And it's also a lower probability event. And I think a good way to distinguish there is think about fender benders versus totaling your car. Okay. And so we know, fender benders happen with much more regularity. And that's where where it's not as simple as needing insurance, not needing insurance, but the difference there is what your deductible is, right? So that's why high deductible policies are so much less expensive than low deductible policies. If you have a zero deductible on your auto insurance and the car company or the auto insurance company knows they're going to need to pay for every ding and dent, it's going to cost you. But if you're willing to say, hey, that stuff, that high probability stuff, my cracked windshield, my, crumpled fender because somebody backed into me at the supermarket, I'll eat that. I'll pay for that, up to $1,000 or, something reasonable. That's different. And no, I'm not going to, I'm going to hate writing that check to the body shop, but I'm probably only writing that check myself a few times in my lifetime. Right. And I'll take my chances on that. Now, if I was to total my car, that's different. I need to replace the car and I need to pay the bank back. Mm-hmm. So,
yep. Yeah, I think, one of the things that you have to remember when it comes to something like mechanical coverage or warranties is insurance companies are really good at two things. They're very, very good at marketing and they're very, very good at math.
They can do the statistics. They can run the numbers. That home warranty program that advertised itself to me yesterday, they know how many people they need to charge $20 a month to make their money at the end of the day. They know they know a very low percentage of people are going to actually make a claim that falls into those parameters that they're willing to cover, and they'll be profitable. They'll be very profitable. One that always gets me is cell phone insurance. That, every time I bought a new cell phone, they asked me if I want to insure it. And, what would happen if my cell phone completely died? Yes, I would have to replace it. Would I be happy about it? No.
Yep.
Would I dig into my emergency fund and cover it and grumble? Yes. And then life would move on. But if you buy the insurance on it, by the time those contracts are up, you've paid for two phones, essentially. I mean, it's...
Yeah, exactly. I have a 11-year-old son. And so he has a phone, and I just had this same conversation where he smashed his phone and we had to go get a replacement for it. And I didn't have the insurance on it. And of course they were trying to sell me the insurance, but I was doing the math and I'm like, well, if I buy the insurance, I guarantee that it's going to cost me about the cost of a phone in 2 years. If something happens, I might be a little bit better off, but if nothing happens, then I'll be a lot better off by not actually paying for the insurance. There just wasn't that big of a gap between, hey, this will be really if it was $2 a month, that's a whole different story than if it's $15 a month or whatever it is for the life of a cell phone.
So instead you just scare your son real well and tell him what it's going to cost him.
Well, That's exactly, it did cost him to replace that phone, so he's fully aware. Hopefully,
but
that's a good learning experience for him.
I think like buying mid-level, electronics now at the checkout counter. You do self-checkout at Walmart or Best Buy, and it's I can't believe the number of things they've asked me at the checkout counter. Do you want to warranty this? And it's like
yeah. I mean, it could be something silly for like $100.
So
for
a 10% increase in my cost, if the product's not going to last a year or whatever their thing covers, I probably should have done more research on the front end before I bought it. So,
right. Well, again, that's like the marketing thing. Like most people look at that. My wife would be a perfect example. Which should just another $10, throw it on top. Like because people don't think about it, or they think it's such a small amount that they just do it anyways, knowing that
these things
that
really are
lost.
They really are preying
never get anything out of it.
on behavioral finance and the way people think about money. We don't like if you can take the risk,
sure.
we deal with clients and risk all the time, right? If you can take the risk out of something, people value that in a way mentally that doesn't make sense necessarily from a financial standpoint. And they prey on that.
Well, and for sure. And, I guess, and this is why we've talked about it all the time, but having that contingency fund, having that emergency fund is so important because it is your insurance policy against all of these things happening to you, right? You don't have to say yes at the checkout. You don't have to get the cell phone insurance. You don't have to get any of the small or the home maintenance because you have an emergency fund. If you don't have an emergency fund, it becomes a little bit different in terms of like if you know that you don't have that $1,000 to replace something, then you have to think a little bit harder about, do I spend this knowing that I can't go and live without this thing, versus do I try to build up my emergency fund? Can I do both? It's a little bit harder of an equation. But the best step in all of this is an emergency fund. Every time, they ask me, do you want the Apple Care insurance? I say, no, I have an emergency fund. I don't need that. Like I have enough money to buy a new phone. I don't need to insure this phone. Something
and it's important, I think, to point out that at a certain point you had to sacrifice a little bit to create that emergency fund, right? I mean, that took a little, and there was a time in there where there is some risk. And the insurance is all about transferring risk, right? So that it's not like we're saying that risk goes away, but it's limited to that period of budgeting and sacrificing to build up that emergency fund. And you've got to have the discipline to say, like, a little tongue in cheek at the beginning, I said, what if you took that $20 or $30 and put it in a savings account labeled, appliance repair fund? I wouldn't literally do that. But you've got to have the discipline then to remember that that's not my vacation fund. That's not my, redecorate the living room fund. That's my break and glass in case of emergency, contingency fund.
Yeah. Well, great. I mean, we have a car fund where I put extra money in because I know there's going to be oil changes or routine maintenance or things that fall off, So there, and I tend to drive older cars, and so that's a part of it. I know they have auto care insurance policies now, but at the same thing, like the cost versus the benefit. Is
and like my auto maintenance repair bucket in my savings account is essentially equal to what my deductible is on my auto insurance. And if I take $90 out of it because I needed an oil change and filters or something in a particular month, I put that money back into that fund because I want it to be close to what my deductible would be if I did have something that was covered mostly by insurance. I kind of know that's my backstop. So.
Right. And it allows you to potentially have a larger deductible because you have that money available, right? Which ends up saving you money every month.
I'm not afraid of those little minor costs. So I know.
Yeah. So let's highlight a couple of things that maybe
Yeah.
we covered most of them, Dave, but let's talk about like what are the list of things that you should be weary about or
Well,
look a little harder into. We talked about
right.
insurance on your cell phone, right? We talked about the home maintenance
I get
warranty. What else is
calls,
there?
spam calls daily on extended warranties on my car, you know. And
Oh yeah.
again, yes, it would really stink if the transmission fell out of my car. But my car with the mileage it has
hmm
on it, I assume that's going to happen at some point. It's kind of built in to my budget that I'm going
Right.
to
Yeah.
more likely like I'm either going to have
hmm
to make some major repairs or I'm going to be replacing the car. So my mental calculation is I need to
Right.
be saving for either a down payment or some major repairs over the next couple years. No, I'm not going to
hmm
buy an extended warranty on my car. Again, they've done the math. They know what the odds are.
Yep. Right. And those are another one of those policies
Yeah,
that are littered with exclusions
yeah.
and things you got to look out for and things they
Oh,
do and
yeah.
don't cover. And, when you really get into the nitty gritty,
Yeah.
the's not a lot of room
Basically,
for
yeah,
you to
it's
actually
mechanical
benefit.
failure that's their fault. Is really what it comes down to.
Right.
You're covering against your car being a lemon. Um, but accidental death
Yeah.
and dismemberment insurance, I see you put this on the list. I like to bring that one up because that one preys on emotions, right? And
Oh, for sure. And it's so,
yeah,
the other thing is it's so darn
it's because
cheap.
it's
And the reason it's so darn cheap is
right,
because they
right.
rarely pay
They
out
they know
claims.
that while everybody dies, very few people die in things that would be deemed accidental death and dismemberment by the insurance
Right.
company. So
Yeah.
they take this like grisly thing and they're
Yeah.
like, wouldn't you want your wife to get a check, if this happened to you? Well,
Right.
if those are the circumstances, I have regular life insurance in place for those kind of, and but
Yeah.
but yeah,
Right.
and it's just a little way for the insurance company to goose up the premium a little bit on something that's probably not going to cost them anything.
hmm Yeah, absolutely. And that's one of those where, again, an insurance company is very good at the math. I
Yeah.
guarantee that they did not price that wrong. And I
Oh
guarantee
yeah.
that they're making a profit off of it. And so the bigger thing with the insurance piece is make sure you have the
Yeah.
right amount of coverage. And then, with that, is going to pay out. And then you don't have to
Yeah.
worry about the
And
extras like an
we
accidental
were
death
talking
and
before we
dismemberment
came on the
policy.
air that we really deserve life insurance deserves a whole separate podcast. But just
Yeah,
in
for sure.
general, accidental death and dismemberment insurance isn't a good deal. But we need to go into the details on term life versus cash value life and how to
Yep.
distinguish between them and when they're appropriate. And,
For sure, for sure. The big thing that we can say for today is make sure you know how much you need and have that coverage in place in a policy that's going to pay out, and we can kind of talk the
yeah.
specifics of what that means and what that
Well,
looks
and
like
you've
at a
got
different
cancer
episode.
policy on this list too. And I'm not I haven't had to deal with cancer policies very often, but that's another one where there's a little bit of a fear factor, scare factor, emotional impact to it. Um, and again, the companies have done the math, and I would much rather have
hmm
for myself a broad life insurance policy, you know.
Yeah. Well, and then the cancer case, the way that I think of it in terms of a cancer policy is it's really more
Right.
about a disability issue, right? Because if you have a short term terminal cancer, you're probably not too worried about like where the money's coming in
Yeah.
if it's 6 months or so, right? I mean, you are to some degree, but also there's bigger things to worry about. And if you have a proper life insurance policy and you get terminal cancer, that you
Yeah.
can actually use some of those funds. And 99% of those policies have a
Yes.
terminal illness rider. But the bigger thing is if you have a cancer where you can't go to work for 2 or 3 years,
Right.
what are you going to do? Right. And that's where the disability policy comes into play, because if you have a long-term disability policy and you can't work, that should
Right.
kick in to replace your income. So you should have that coverage. And the cancer policy oftentimes gets thrown into the
Mm-hmm.
accidental insurance, the big players in terms of the accident realm of a lot of employers have these policies out there. And that's another one of those things where, an emergency fund is a great tool. So if you had an accident and had some higher expenses, you have an emergency fund to pull from. You don't necessarily need to have an accident policy if you have that in place. And I think of it in terms of, the insurances that I'm really worried about people having are having enough life insurance if you're in that stage of life where someone's relying on your income, having enough long-term disability insurance. Again, if somebody's relying on your income, you want to be able to replace that, especially the younger you are, the longer that time frame could potentially be. And then the third one is the home and auto. A lot of that, unfortunately, is a requirement and some of that for a really good reason, and other parts of it, maybe not so much. So that is important to have the right amount of coverage, and we can throw in liability insurance as a part of that. And then health insurance as well, right? Like having a solid health insurance plan. And we can talk, we talked a little bit about deductibles and things like that. That's one of those things as well, where I'm not so concerned that you can go see your doctor every year and not be able to pay the $200 to do that. I'm more concerned that if you had a major health incident, like a cancer, your health insurance policy would cover that, because that would potentially put you in a place where you would be like one of those catastrophes.
That deserves its own podcast too. But high deductible health insurance plans, the premiums are low, the deductibles are high. And they can work well if you are reasonably healthy and you are a good saver, or a disciplined saver.
Right. Absolutely.
Where you're going to have the money in the bank to cover your medical deductibles if you have them. So, and offers some great financial planning opportunities. But again, that's a whole nother half hour.
Absolutely.
We did.
We unlocked a lot to talk about when it comes to insurance. So just one final thing on the cancer policy, and going back to that, and like the short-term versus long-term disability. I tell clients this all the time. I'm not so worried about what happens to you if you can't work for 3 to 6 months. But if you can't work for 3 to 6 years, that's going to cause a major problem, right? Like we can find a way to figure out the next 3 to 6 months. It's nearly impossible to find a way to figure out the next 3 to 6 years. So what's the exclusion
period on most long-term disability policies? 3 months, right? And what do we normally recommend people try to have in their emergency fund? There you go. There's no magic to this, folks.
There's not.
So, that's why we target 3 to 6 months of contingency fund savings, is so that if you have that occurrence, you can get through that short-term period before your long-term disability kicks in.
Yeah, absolutely. I think that's, if you take away anything from today's podcast, it should be having an emergency fund, a contingency fund of 3 to 6 months of expenses. It's going to save you a lot of money from not needing to have all of these small policies to cover you for things that you have set aside in case something happens. And it's also going to kind of allow you to change some of the costs of other insurance and make sure that, you're insuring what you can't self-insure and self-insuring what you can, and making that all part of your long-term financial plan. All right. So if our listeners have any questions on insurances or anything we talked about today, feel free to send us an email at info@srbadvisors.com, and look forward to a couple more insurance-related podcast episodes, life insurance, health insurance. We got some work to do.
We can add annuities to that
back.
list. We could go on. I think we mapped out the rest of the year for our podcast right there.
Indeed.
Okay.
Well,
thanks,
as always,
Nick.
It's been a pleasure, Dave.
This is a Zedia Media production.